I am now very happy to introduce today's lecture. Our professor who's going to be with us today is Dr. Thomas Davidoff, who is Associate Professor and Director of the UBC Center for Urban Economics and Real Estate at the Sauder School of Business. Today's lecture, The Costs of Commuting, Cities, and COVID-19. I now turn things over to you, Dr. Davidoff.
Thank you very much, Marg. I really appreciate the introduction and the opportunity to speak with this group. So what do I want to do today? My comparative advantage is in the part about cities and, housing costs and prices. COVID's really interesting to think about in that context, but I'll do a little bit more urban modeling than conjecturing about COVID and where it's going to go, especially the work from home trend. But I do want to provide a model through which we can see what the effects have been of COVID on cities and what they will be if these work from home trends continue. So we'll walk through a model of real estate pricing, a classic called the Gordon growth model. We'll talk a little bit about the idea of agglomeration, that people like to be in cities and that firms are more productive when they're around other firms and lots of other workers. We will go through another workhorse model of urban economics that talks about where rents come from and how rents and prices grow over time with demand. And then we'll fit COVID into those models and ask if we can explain the major movements in prices, both the upward trajectory of prices and the geographic patterns we're seeing in which markets are doing better and which markets are doing worse. Okay, so that's the plan for the day. And the first thing I want to talk about is the so-called Gordon growth model of asset pricing. Okay, so why are home prices so darn high? It's in the news that housing costs, obviously a major feature of the Vancouver landscape, but they're becoming a major feature of Canadian cities and suburbs. And so it's worth just having a quick model for that. So suppose you live in a world where you need a total return on your money between capital gains, that your asset grows in value, and inflation of R. So what's R? R is some outside option. Maybe you could take your cash and put it in a treasury and get yield R, some risk-adjusted rate of return, okay? Now you have an asset that pays you X dollars this year. For a home, that would be the rent you'd get if you were the landlord, minus all your expenses, property tax, insurance, maintenance, something for capital improvements, okay? So assets pay out some amount of money this year and they grow at some rate. Call that rate G. Well, if you pay V dollars for the asset as a purchase price, then every year you want to earn a return V times R, because otherwise you should put your money somewhere else. But it doesn't all have to be dividend yield, right? Because assets grow in value. And of course, real estate in Canada has grown at a very high rate. So the dividend you need is your total return, V times R, minus how much your asset is appreciating, V times G. And so what we say is that an asset, then just sort of doing a little multiplication and division, the worth of an asset is the current yield X over the rate of return you're required on your money minus the expected growth in value in the denominator. So that R minus G in the denominator, well, that really explains why real estate has gotten so expensive. If you think about a market like Vancouver or Toronto, today, our required rates of return are incredibly low. Those of you who save in treasuries have seen that. Yields are as close to zero as we've ever seen. And G, the growth rate, at least in rents and prices in Vancouver and Toronto, has been very high. So this denominator is very close to zero. And when you have a denominator that's close to zero, you get numbers that are very big. Hence, real estate really expensive because of low interest rates and high growth rates. There's also huge uncertainty, right? Most of us thought COVID would be bad news for housing markets. Instead, it's been good news. There's lots we don't know. We don't know where interest rates are going. We don't know where rents are going. We don't know how much new supply will get added. We don't know what the federal government will do with taxes. So there's uncertainty over the growth rate of home prices and changes in interest rates. And when that's true, when you've got this denominator R minus G that's close to zero, uncertainty can mean you have no clue what assets are worth. So a lot of people say we're in a bubble, homes are worth too much, but are they or are they not is very hard to know, right? Suppose this R minus G with different assumptions could be off by 1%. So suppose it's either 2% or 1% in the denominator. That uncertainty of 1% would be the difference between saying a condo is worth $500,000 or $1 million, okay? And it's very easy to be off by 1% in your guess of what the right numbers are for opportunity cost, risk adjusted of an investment, minus how much you think the asset's going to grow in value over time, okay? So there's always uncertainty, but today, when the difference between rates of return on assets and growth rates of real estate with such a small difference, huge values, huge uncertainty. Okay, so that's one basic model that tells us why prices are so high today. Okay, the other thing we need to understand is agglomeration and cities. As the existentialist tells us, l'enfer c'est les autres, hell is other people. Why do people pay 1.8 million at least in Vancouver and Toronto for small homes, when buying those homes makes you live with congestion, crime, noise, shadows, all the disamenities of living in crowded places? Why do people pay so much? Well, the answer has to be that there's benefits to living near other people, even as annoying as other people can be. There's economies of scale for amenities. You don't put an opera house in a small town because you don't have enough attendees. You can put a baseball stadium, a museum, etc., when you've got lots of people around. So cities, people will pay extra to live in cities because you've got these nice amenities. Of course, there may also be productivity. If anybody's been to Bay Street, there's just armies of people in suits doing office jobs. Maybe they learn from each other. There must be some benefit to being so close to each other because offices go to great lengths to be downtown. They pay a lot of money, and they have to compensate their workers for living with all the congestion and disamenity of crowding, okay? So there's something great about cities. Exactly what it is that makes cities so important and makes people want to live in crowds, that's a bit of a puzzle, sort of overdetermined. If you look at data, lots of things move together, amenities, productivity, they move together. So what exactly it is that makes cities productive places is a little hard to know, but there's definitely something there, because if there weren't, nobody would pay the kinds of prices people do to live in cities. Okay, COVID, of course, has changed that calculation, okay? All the disamenities of cities are still there, particularly crime seems to have gotten worse in downtown. Congregation of homeless people, which is upsetting and something to be upset about just because of the sadness of other people living that way, but it can also be something that makes people feel uncomfortable, okay? So the amenity of big cities is falling with COVID, and of course, the productivity isn't there. People aren't sitting in office buildings right now. And so a giant question for the future is, will this work from home phenomenon persist even after COVID? I think kids are going to go back to school. I know university works better in person, but do businesses work better in person? That's not so clear. And then the question is, well, if we don't have these agglomeration benefits, what happens to cities and in particular housing markets? So a first point to make is, by no means is this the first go around. In 1998, Ed Glazer in the Journal of Economic Perspectives asked, will the internet kill cities? And he starts out, is the city dying? Professional seers such as Richard Naisbitt and Alvin Toffler have argued that information technology, this is back in 1998, like when you had basically the fax machine and the dawn of the internet, is rapidly making the need for face-to-face contact in cities obsolete. Experts on the inner city see inevitable urban decay, and he talked about what was a big deal certainly in the 80s and early 90s, all the crime and homelessness in cities. So people were fleeing cities, and it seemed like the problem was going to get worse with the internet because, 20, 30 years ago, people had already figured out when you have easy person-to-person communication by remote, what do you need to go through all that trouble to be in person? Glazer didn't think so. Glazer did not think cities were dying, and he was right. Okay, the value of person-to-person interactions, it seems like the internet is a complement for person-to-person interaction. With the internet, you get to meet people and chat and have ideas, and that makes your person-to-person interactions apparently more valuable, not valuable. So that was one big disruption, that sort of made work from home possible. But between 1998 and today, 22 years, cities have grown tremendously in value, and suburbs have fallen in value relative to downtown. Okay, so to give a little bit of a framework for thinking about how something like work from home might affect the shape of cities, it's useful to think about the so-called monocentric city model. And the monocentric city model has a few ingredients. So we think about locations as indexed by their distance from a single downtown. So the horizontal axis on this graph is distance from downtown. The vertical axis is how much does land or housing generally cost per square foot. And, you see it everywhere. The further and further you get away from downtown, generally speaking, rents per square foot fall. Now, sometimes housing prices can be higher in the suburbs. So a house in West Vancouver will cost more than a house in East Vancouver, even though West Vancouver is much less conveniently located to downtown. But that's not an apples to apples comparison. Those are generally bigger houses on bigger lots with better finishes. Apples to apples, you usually see, not always, but usually see higher rents and prices per square foot the closer you are to downtown. And we think about a city as encompassing all of the area up to a boundary. And that boundary occurs when this black line, which is a schedule of rent per square foot as a function of distance, when that willingness to pay intersects with the cost to develop housing, okay, or an annualized cost to develop housing, that's where we get a fringe. And past the fringe, we get cows and plants and farms. And within the fringe, we get homes. And within that fringe, where the homes are, per square foot, the closer you are to downtown, the more valuable. This red line represents growth relative to the black line. Over time, what happens to make cities grow? Well, more people want to live in the city. To accommodate them, you've got to build. Within the boundary is already built out, so you can do some redevelopment, which is very controversial, or you can expand the fringe. In Vancouver, that would be out into the Fraser Valley. And as the boundary expands, well, we know rent at the boundary is going to equal the cost of developing housing because people are just indifferent. They're not going to pay any premium above that. But between the boundary and downtown, you get convenience premiums. And as the boundary expands, relatively, interior locations are more better than the boundary when the boundary is further out. Okay, so we grow demand, we shift out the boundary, and because commuting now is so inconvenient from the boundary, you pay a bigger premium to live at a given location. So that's our basic idea of why rents and prices grow. The fringe of the city grows, and so relatively the interior locations are more convenient compared to a place where cost is construction cost than they used to be. Okay, and Vancouver clearly has a rent gradient. Here I took some scrapes from Craigslist data, and I took bedrooms and square feet and bathrooms, and I sort of controlled for that with regression analysis. And then I plot longitude and latitude. So this is up and down is longitude, horizontally is latitude. And each dot is a Craigslist listing. And red is a higher quality adjusted rent, and blue is a lower quality adjusted rent. And of course, neighborhoods are diverse. There's different types of homes within neighborhoods. But generally speaking, the closer you are to downtown or Kitts Beach or Jericho, the higher your rents are. As you get to less convenient, lower amenity locations, with all due respect to Surrey and Richmond, rents and prices fall, holding quality constant. Okay, so like other cities in the world, Vancouver has a rent gradient. Cities mostly like this, even cities that are famous for sprawl. Here's the fraction of land that's developed by location. And this is Dallas, Texas, a city famous for being a sprawling place where people don't particularly want to be downtown relative to other locations. But a darker pie slice here, this is increasing distance from downtown, north, south, west, east. Darker pieces are more intensely urbanized. Lighter spaces are pasture land, not for urban use, okay, or farms. And what we find is the more intensive use is closer to downtown. Not totally monocentric, but generally speaking, cities radiate out from a downtown. Now, other cities are more classically monocentric, single-centered, right? Here's metropolitan New York, extremely dense. Almost all available land, except for a few parks, is developed in Manhattan and close to Manhattan. And as you get out into the suburbs, eventually you get to some farms, but it takes a while and there's a clearer pattern in metropolitan New York. Phoenix, another famous sprawling city, but generally development occurs from the inside out, even in cities known for their sprawl and lack of a downtown. Okay, one thing to sort of think about, it's a little more math probably than I should do in this forum, but where does this slope come from? Mathematically, just why is it, or by how much do people prefer living close to downtown than farther away? We know in New York, this is going to be a steeper curve than in Phoenix. People are closer to indifferent. In Vancouver, we see a pretty steep gradient. Where does the gradient come from? Well, one formulation would be that call T the cost of transportation. Moving 1 unit of distance out away from downtown may cost T, and R is how much rent you pay. So if people are all the same, which is a decent starting point, moving 1 unit of distance farther out from downtown shouldn't leave you better or worse off. So what happens to me economically if I move a little bit farther away from downtown? Well, if I move farther, I've got to pay more in commuting costs. But my rent might change, and on a per square foot basis, I'll multiply that change in rent times how much land I consume. So the cost of commuting, T, going one further out, should equal the benefit of moving further out into the suburbs, which is how much land I consume times how much I save on rent per square foot. And we get this very simple equation. The slope, the steepness of rents as you get out from downtown should be how much people dislike commuting, T, divided by L, how much land people consume. And so you'll generally get a steeper slope closer to downtown than out in the suburbs. Why? Because out in the suburbs, people consume more land. So when you have more land, the denominator's smaller, you get a flatter curve. So land-intensive uses like a Walmart or a warehouse won't go downtown because they're just, there's so much land consumption, it's expensive to consume the good locations. Urban land uses tend to be uses where it really matters that you're close to lots of other people. So T is high. It's very costly to get away from downtown. And L is small. Stuff that can be packed into small spaces tends to be what goes downtown. Okay, so that's rents. What about prices? Well, basically what you'll find is this theta is a measure of that transportation costs. How much rents grow when the border expands depends on how much people care about commuting. Okay, so price growth is going to be greater, of course, when there's more demand, because the further I shift out this red line from the black line, the more demand grows, the more rents and prices rise. But two other things are going to really matter. One is, how steep is this curve? The steeper the curve, the bigger the effect of shifting out the boundary, okay? The other determinant is there any land to build on out at the fringe? Vancouver, Greater Vancouver, is famously hard to build in, and the area on which you're allowed to build is very limited because you've got the US border, you've got ocean, and you've got mountains as impediments. And so Vancouver's a place where rents are going to grow a lot over time because you have to really shift that boundary way into the Fraser Valley to accommodate a lot more people. Okay. What is work from home going to do to all of this? Well, and you'll pardon a hand-drawn drawing. Here we go again with money on the vertical axis and distance from downtown on the horizontal. Well, what COVID does is you start out with this steep rent curve because, the world was dominated by young people in their 20s, are a lot of the first-time buyers who are so influential in housing markets, and they consume small spaces and they love to be downtown and congregate with other people. So we had steep bid rent curves. And recently we've been seeing big premiums for downtown and less so for the suburbs, especially after the foreign buyer tax. Okay. But what does COVID do? It flattens this curve. The cost of transportation is getting close to zero. People don't need to be downtown anymore because there's work from home. And lot size, if things persist, we're going to see a shift. People are going to want bigger homes, not smaller homes. And so per square foot, people won't be willing to pay big premiums to live downtown because they'll really want to be consuming land rather than convenience. So with a flatter bid rent curve, what do we get? We get lower rents downtown, relatively higher rents in the suburbs. That gets converted to prices too, and that's what we've seen. Detached homes in the suburbs, people want more space with COVID, have increased in value. Small apartments where you have the advantage of convenience, not as much of an advantage as it used to be. And so we see relatively weaker price appreciation during COVID downtown than in the suburbs, where commuting just got a lot less bad and where the big space is appreciated. As anybody who's been working from home with other people knows, tripping over each other, duking it out over the good Wi-Fi spaces is a real challenge. Okay, so kind of fun to think about COVID just as an intellectual exercise. To think about what COVID's done, we can think about flatter versus steeper bid rent curves for a lot of comparisons. So apartment versus detached. Why is it, other than restrictive zoning laws in the suburbs, that we tend to see apartments downtowns and detached homes in the suburbs? Well, detached homes consume a lot of land. When you have a lot of land use, you're not willing to pay a big premium per square foot to live downtown because it's just too expensive because there's too much land. So detached houses get outbid downtown and they're out in the suburbs. Walmart versus Starbucks. We see Starbucks downtown. Why? Starbucks relies on walk-in traffic. They have to be close to the action. So effectively, they have a big value for tea. It's very hard for them to be in inconvenient locations. And they'll pay a lot per square foot in rent to be close to downtown because it's not so bad because they consume small spaces. Low L, big T for Starbucks. Walmart, on the other hand, draws its own traffic because it's a destination, so T isn't such a big deal. And they can't pay for urban locations because they consume too much land. Yuppies, young people with no kids, of course, they live downtown. Families who have more needs for land, they tend to live in the suburbs. Now, a really interesting question, and I think COVID will have some influence here, is who lives downtown? Richer people or poorer people? It's a bit of a horse race. Time, the cost of commuting, if you're a highly compensated person, your time's worth a lot, so you want to be close to downtown. On the other hand, you consume more land when you're rich because people like bigger homes. So whether it's the poor who will outbid the rich for downtown because they're not consuming very much land, or the rich will outbid the poor because their time is more valuable, is a bit of a horse race. And we see both. There's some urban locations like Yaletown that are very expensive. And not only expensive, but the homes are expensive. They're filled by affluent people. And there are remote suburbs that are low income, but you also see the opposite. You see the downtown east side where many, many people crowd into spaces, sometimes even on the street, that are small spaces. So you can have low income people outbidding higher income people for some urban neighborhoods. And you can have very high income locations in the suburbs like West Van, and almost all Vancouver suburbs have some affluent areas. Okay. So COVID, again, the big thing to think about COVID is you flatten this bid rent curve. You make downtowns less valuable, suburbs and even non-urban areas more expensive, okay? So what's happened during COVID? Prices have exploded. particularly for single family homes and particularly in remote locations. That's not exactly what people thought COVID would do. The big thing people thought about COVID, I think, going in, and CMHC, the Canada Mortgage and Housing Corporation, and I agreed, lots of people's expectation were lower incomes would mean falling housing costs. With lower income, you just can't pay more for rent. And so rent growth would stop. Maybe a lot of homes would become vacant because tenants wouldn't be able to pay the rent. And a lot of us people anticipated a crash, but that's not what's happened. Prices have risen dramatically. Why? Well, in the Gordon growth model, R has fallen. That denominator, R minus G, I don't know about growth expectations, but rates of return have fallen. And so that's increased prices, holding rents about constant. Rents have been about flat, but single family home rents and prices have done better than condo. And again, in that monocentric city model, we've got a flatter gradient because commuting costs are just less of a big deal than they used to be. And then there's demand for space. Of course, people want the bigger homes, and condos are smaller than detached homes. And I think another issue that people certainly report is that just as you don't need to commute to go downtown anymore, urban disamenities, crime, and in-your-face homelessness and the upset that induces has gotten worse. So the question, I think, for thinking about cities and particularly housing markets is, will these effects last, right? Are we going to continue to see a pattern where these bid rent curves look more like the green and less like the black? And that answer must depend on how permanent this innovation of work from home is. If work from home is permanent, if people are going to go to offices max once or twice a week, well, then we've got permanent effects. If at the end of COVID, it's back to business, everybody show up, next Monday, now that we're all vaccinated, well, it's a very different story then. And maybe we revert to the trend, which is increasing values for apartments, decreasing values for single family homes, and general distaste for commuting. Okay, so what can I say? I don't have a lot of evidence on the permanence of work from home. My Commerce 394 students, from whom I learn a lot about what's actually happening among real human beings, as opposed to academics who've been stuck in the ivory tower for a while. If you ask them, they say they want to work in offices, but only 2, maybe 3 days a week. So, certainly if I'd asked students, do you expect to work in an office after graduation 5 years ago, or even 3 years ago, I think 90% would have said yes. Pretty much none of my students raised their hand when I said, how many of you hope that you have a job where you're at the office 5 days a week? They don't love Zoom for classes, but I think they do want to integrate work from home about 50% in their work lives. So that's a piece of evidence. We know open plan offices and coffee shop working was rising even pre-COVID. The internet allows it, and some people were already taking advantage of it. Dropbook and Facebook have stated that they're going to permanently allow work from home. Now, a business allowing work from home doesn't mean everybody will work from home. Being in person can help your careers in many ways. Maybe you're more productive. You certainly have the opportunity to kiss up to the boss if you're physically close to the boss. Okay, many other anecdotes. So if you ask any firm, all the employers I've spoken to said, this work from home is great. We're saving so much money on rent. Downtown rents, pursuant to the picture, are very expensive. And so businesses are pretty happy about not having to pay rent going forward. CMHC, the Canada Mortgage Housing Corporation, they had shifted to largely work from wherever you want, even before COVID, and they've been pretty pleased. The question is what's happening to productivity, right? Are businesses suffering from workers not being next to each other in person, or are workers more productive because you don't have to commute for an hour a day? Nicholas Bloom and some co-authors before COVID found work from home enhanced productivity in one particular case study. There are many such case studies. I think the evidence is pretty mixed. I don't think there's compelling evidence that work from home crushes productivity. Obviously, there's some tasks that must be performed in person, but law firms, IT, I think a lot of services that are traditionally downtown probably can be performed largely work from home. On the other hand, as I mentioned, we have the time since Ed Glazer wrote his conjecture that cities would be okay despite the internet, and that was right up till COVID. So, maybe it took COVID to shake firms into trying the experiment of work from home, and it works great. I don't know. I don't think we know what's going to happen. One thing we do know is during COVID, there's been significant outmigration from New York and San Francisco, which are sort of, in a regional sense, the downtowns of the United States. And we do know there's been continued movement to Austin. That's been on trend, but the decline in population in New York and San Francisco in the face of COVID, that seems like it might be something that's hard to reverse, hard to know. One other piece of history I wanted to mention: a prior flattening of urban gradients did not end well. This picture is a picture of the so-called drive to qualify phenomenon in the US. The vertical axis, each dot is a zip code in the US, and they're regional. There's the sand states of Arizona, Florida, Nevada, California. There's the coastal areas, the places that on US election maps are blue: New York, Washington, California, Oregon, Massachusetts, Connecticut, Rhode Island. Blue, and then red is what they call flyover country, the places that typically vote Republican in the US, okay? The vertical axis is what's the fraction minority, but you could also look at distance to downtown. The boom and bust happened in the subprime so-called drive to qualify suburbs far from downtown. When you had a technological change to lending, where people who previously couldn't afford homes were encouraged to buy homes, those were typically in distant, remote locations, and those were the locations that had the biggest boom and bust cycle. The vertical axis is how bad was your 2000 to 2007 boom bust cycle, and it was much, much worse in the highly subprime areas. So that was a case where from 2000 to 2004, going from the city to the suburbs was, there was much greater price growth more remotely, but the bust after 2005 was much worse in those locations. So summarizing, housing market dislocations that we've seen are rationalizable in COVID, okay? The decreases in interest rates from a low base has meant very rapid price growth. The flattening of rent curves has meant suburbs have outperformed downtown. So totally rationalizable. The question is, will it be permanent? And a lot of that depends on whether the reasonable productivity we seem to have from work from home is going to lead firms to reconsider the importance of having everybody to commute downtown. What firms and workers settle on, very important. Recent history, though, tells us agglomeration is difficult to kill. Thank you.
Thank you very much, Dr. Davidoff. We now have a number of questions that have come in. Are you able to see those?
I am. So I'll just
okay. I'll read them
perfect.
just so you have a chance to think about them. And I do encourage anyone who might have some questions, once again, to go into slido.com and 1 hour 0420, which is showing on the screen here, is the code that you will use. Okay, so the first question: are there huge differences between major cities in Canada as far as how COVID has affected commuting?
Yeah, so that's a good question. I think the only answer I can give is cities where there are larger commuting premiums, particularly Vancouver and Toronto, certainly seem to be the cities where we're seeing both the most rapid price growth, but also the most significant shift to the suburbs away from downtown. And in the US, it's the same story. It's New York and San Francisco where those dislocations have been greatest.
Okay, thank you. Next question: will soaring insurance costs in condos deter purchases in Vancouver?
That's a great question. So that's a second headwind facing condos relative to other forms of housing. Insuring against construction problems or mechanical problems that arise. Vancouver House just famously had a giant flooding issue, and that's going to be extremely costly, and insurance companies know that, and it started to be very costly to buy insurance for these big new strata condo buildings. So yeah, I mean, I think if these buildings, I don't know if it's insurance costs, because insurance is just, even when it doubles or triples, it's not a huge number insuring a building. But the general problem of, is it physically okay to build these giant apartment buildings when a lot of other buildings are getting completed, or are there systemic problems? Yeah, I mean, I think that's a headwind for the condo market, in addition to the COVID problems.
Thank you. How does the expansion of rapid transit affect housing affordability along transit lines and in suburbs?
Well, that's a great question. So reducing transportation costs is a shift. Remember, there was that picture, the hand-drawn picture with the steep black line and the flat green line. We think of improving transportation basically as flattening that curve. It gets relatively better to live in the suburbs and relatively less of a big deal to buy downtown. So that lets the boundary between urban and rural grow more to accommodate more people, having less impact on prices downtown. So absolutely, reducing T in that T over L formula is a very important way to improve affordability.
Thank you. How will an increase of 1%, 3%, or 5% in mortgage rates affect must be costs in Vancouver and Toronto, in addition to work from home? Is that a perfect storm for a housing bubble?
Yeah, so if all else constant, interest rates doubled or tripled, that would be a huge impact. You know, it doesn't double or triple your payment on your mortgage because there's amortization too. But in that Gordon growth formula, you know, you change that denominator by 2%. When the denominator is 2%, if it goes from 2% to 4%, you're cutting values in half. Now, the good news is interest rates will probably grow in a world where G is higher, right? Central banks raise interest rates when the economy's overheating. So what you really are interested in is real interest rates, the difference between R and G. But that could certainly change, you know, zero real interest rates, you know, the interest rate minus inflation where we are now, historically, it's been much greater than that. So yes, I think there's considerable risk to the downside that real rates could rise. I'm very surprised that, you know, in 2007, I thought rates would be as low as they were then for a short time. And they've basically been that low for 13 years. We haven't lived through such a prolonged period of low interest rates. So that can mean one of two things. One, we're just in a different world and rates are low forever. Or two, we're at tremendous risk of declining asset values with higher real rates. And, you know, I don't know which of those two is correct.
Thank you. As a first-time buyer with a modest salary, I can't afford any decent property. How do so many people buy homes if they don't have the salary to support it?
It's a good question. I guess, you know, the speaker would have to answer whether the problem is accumulating a down payment or whether the problem is supporting the mortgage. You know, we do have the stress test. So, you know, even though, you know, economically homes are much more valuable because of low interest rates, for buyers who are constrained, the government has this stress test which says they qualify you based on your income, not at today's low interest rates, but at a much higher interest rate to make sure you're able to make payments, even if pursuant to the previous question, interest rates go up. So, you know, it is a real problem. And in that Gordon growth model, let me go back to that, you know, rent over R minus G. When R minus G gets small, the value of a property relative to rent gets really, really big. And so you see asset prices that are very, very large relative to the incomes that can be allocated to housing. You know, about a third of income is what people qualify as affordable. Just mechanically, when rates are low and growth is high, that means your lifetime earnings get pretty small relative to the value of a house. So, you know, people who own other assets already have had their down payments grow. So, you know, people can refinance their homes, take out cash, and they can afford to put large down payments on other properties. And I think we get a lot of direct investors in the market. And of course, the bank of mom and dad, if you have affluent parents, that can help you put down such a big down payment that your regular payments get affordable. But that's not everybody. And I am very concerned that if this low interest rate environment persists, the basic model of using, you know, 30 years of labor income to pay off an entire home, that just may not be very sustainable. We may have to get creative. CMHC has started to do some sort of equity sharing models. Maybe you do that in retirement. Reverse mortgage is likely to become more attractive. Yeah, you raise a very legitimate point. It is very challenging, affordability now.
Thank you. So house prices aren't necessarily cheaper in the suburbs. Does this encourage landlords to increase rent prices because they will have a bigger mortgage to pay?
Let's see. Well, I think maybe you're asking about the ratio of rents to prices, and it is certainly true that fancier homes generally have lower ratios of rent to price. I don't think I think landlords take rents and prices as given. Real estate is a pretty competitive market. So I think the rent on a home is what the market will bear, which doesn't exactly come from the model I drew, but pretty close. You do see variation. Homes that are geared towards affluent people, pursuant to the prior question, more affluent people generally prefer owning to renting, both for the control and for the tax advantages. And so, types of homes that are usually consumed by affluent people will generally have lower ratios of rent to price.
Okay.
That's a fun game, let me just say. If you ever want to say, oh my gosh, it's gone away a little bit, but especially right after the speculation in foreign buyer taxes, you could play this game of looking for rentals in the British properties. And the monthly rent might have been $3,000 on a $6-7 million house. It was a pretty remarkable disconnect.
Thank you. Next question. Do you anticipate that companies reducing downtown office sizes will drive down rental rates, or will we just see more smaller offices?
Yeah, so WeWork seemed like a really great idea, which was essentially chopping spaces up and subletting to smaller uses. It turned out to be a scam, largely, but it might have been a real thing as well. And, the flex office, right? People use coffee shops as offices. You could definitely see a model where when you're not working at your downtown office, you still want to have meetings with other people just because your employer isn't providing you a desk at which to base yourself. You still may want a home base. So I certainly could believe subdivision of space, for small firms or even individual entrepreneurial people or office workers who want a base. I could see that happening. But I think that'll certainly come along with reduced rents to the extent work from home is a big deal. I think that the first order effect would be just lower rents and less demand for offices downtown.
The next two questions refer to downtown. So the first one, will the suburbs develop downtown? And then will the concept of downtown even disappear?
Yeah, I'm forgetting the author's name, but when I got out of college in 1993, a book everybody was reading was called, Joel Garreau wrote a book, Edge Cities, about these places like, Surrey in Greater Vancouver, or Burnaby's Metro Town, or Crystal City in DC, or Tyson's Corner in DC. There certainly are downtowns in the suburbs. That's a real thing. That monocentric city model where there's a single location to which people commute, that's not exactly accurate. The Bay Area of San Francisco is a classic of that, right? There's a lot of locations that have a lot of value, but they're at multiple centers. So yeah, those polycentric cities, that is a direction cities have been heading for a long time. And you could certainly see the growth of that with the advent of work from home. As to the second question, will the concept of downtown disappear? I tried to point out there's pros and cons in terms of that. It's certainly possible that work from home could lead to people to live in the country, not even in suburbs, but just in disaggregated, beautiful places. On the other hand, people like to hang out with other people. It's just a solitary confinement. For some of us with large families and busy work lives, it seems like the best thing that would happen to somebody under punishment. But it makes people miserable. People don't want to be alone. Obviously, young people want to meet up and find partners. So, there's the cultural element of downtown too. My best guess is we'll go back to pretty healthy downtowns, but I just want to emphasize there's a risk that some of that agglomeration benefit could go away. So I can't tell the future, but I think there's arguments on both sides in terms of the future of downtown's centrality.
Thank you. Next question. Actually, I'll go with the one that's got a 1 beside it. What effect will the aging population have on home prices? They will require accessibility to healthcare services, plus they will not be driving as much.
Yeah, I'm glad I didn't have to give advice to the owners of the Bentall Center because, that was just bought for an awful lot of money, and they know as well as I do, But the aging population, that's a great question. So there's a paper written by Greg Mankiw, who wrote the most popular economics textbook and was the leading economic advisor to President George W. Bush. So very famous economist, Greg Mankiw and a guy Weil wrote a paper in the 80s recognizing that the baby boom generation was going to age. And they said the biggest trend in the next 20 years is going to be the reduction in housing prices due to an aging population downsizing and getting rid of their homes. And that proved, of course, to be massively wrong. Between the 80s and the 2000s, prices exploded, as they have continued to after the financial crisis. And, the issue is seniors, just like everybody else, like staying put. People don't like to move and to downsize. So, you say, well, seniors should be near services. They shouldn't be out in big houses in the suburbs. And you do see some downsizing, but you see a lot of people retaining homes until death. But boomers are going to get into very late old age. Eventually, you do need enough help, and you disappear, and the disappearance from ownership of that generation should lead to some transformations, a decline in suburban values, an increase in urbanization, and as the population shrinks, barring more immigration, you'd have a reduction in housing costs, as Mankiw predicted long ago.
Thank you. This next question you alluded to a little bit in an earlier question, but maybe you can add a bit more regarding a potential shift to smaller communities beyond the suburbs, and then the long-term effects on cities if that becomes the case.
Well, yes, the answer is yes, there has been. It's not just from the cities to suburbs. If you look in the housing data, it's the interior, not even Kelowna, but just, beyond Squamish, just rural areas have seen the greatest increase in prices. Now, it's, the question is whether it's sustainable there, because you can build more homes eventually. If you worry about a bubble in prized urban locations that are already built out, it's always hard to call bubble because there's a supply constraint. The growth that's been happening, the most intense price growth, has been in really peripheral and rural areas that, are beautiful to live in, but hard to commute from, which makes sense when you don't have to commute. And yeah, so we have seen that shift, and that could be, that could make metropolitan areas much more affordable. And, the other shift that had already been underway is cities are somewhat of cultural centers as much as they are places to work. So Greater New York, it already happened. The hedge funds, Wall Street isn't really Wall Street anymore. The hedge funds are all out in affluent suburbs in Westchester and Connecticut to the northeast of Manhattan. And the reason people want to be in Manhattan is it's partly the productivity, but the cultural vibrancy is that too. So, maybe cities have to retool a little bit and make sure they're fun places to be if they want to survive, to the extent that they're not, they don't have a monopoly on productivity.
Thank you. Next question. Do you know the ages of home buyers today? Are they seniors buying or just younger people?
I don't have the demographic split. We know the millennial generation is a big part of housing demand, and first-time buyers, we know, buying a bigger house, that can push up prices, but buying a house at all or buying an investment property, those are the things that really drive prices. So I'm confident there's both. I know there are many first-time buyers in the market, who finally accumulated the down payment, have the low interest rates, and are getting in and aging in because of family reasons. But it's also true that there's a lot of investors who are active, who are pulling out home equity and able to put on those big down payments on second properties.
Okay, thank you. The last one is a comment.
Yes.
I got it. The large office towers can become homes for the boomers and seniors.
Yeah, again, that's that earlier question. We do see downsizing, but it takes a lot to get people to be willing to leave their homes.
Mm. Okay, we still have time, a few more minutes for any questions. If anyone else wants to put some in, okay, here's another one.
Right.
Just come in. Are people mostly putting down a bare 5%, minimum 5% for down payments, or people going higher?
That's a great question. From what I have heard, it's higher. You know, most people are not, who are buying in the market today are not constrained. So in Canada, you can go to a non-bank lender, but they charge very high interest rates. The banks have to take at least a 5% down payment. They can't lend more than 95% loan to value for properties below $1 million, and above $1 million, it's pretty much got to be 20% down. Of course, you know, a lot of properties are trading for over $1 million. And so from what I've seen, we're seeing a lot of 20% and more down. Now, there is the so-called silent second. Maybe that's the official data that people have seen, is people have 20% down. Some of that 20% down could be hidden second loans where people are borrowing some of the down payment. But to my knowledge, there's a lot of buyers putting 20% down.
Thank you. Okay, so I think looks like that's it for questions.
Right?
Oh, okay. Here's another one.
Yeah.
I don't understand how people can afford houses or property with the median income in Vancouver not that high in comparison with the prices.
Yeah, I don't think the median income can buy, and I don't think the median income does buy. The buyers, you know, the only something like, I don't know, 5%-ish of houses turn over in a year, 5-10%. So, you know, the people buying those houses are not the median income. You know, the people who move into Vancouver willingly probably have higher than median income. Yeah, buying on the median income is getting very, very challenging. I completely agree. Now, when you think about affordability as a social crisis, the good news is, you know, buying a home is nice to have. Having a home at all, renting or buying, that's what you need. So when you measure an affordability crisis, you're worried most about people at the bottom of the income distribution who tend to be renters. And fortunately, during COVID, rents haven't been growing nearly as fast as prices have.
Okay. Another question has just come in. What about immigrant buyers? Are they affecting prices now or in the future?
Absolutely. Yeah. Immigration to Canada is a very important part of demand growth. I mean, you know, how many places in the world have stable government, you know, pretty global warming friendly climate? You know, fortunately, the country to our south, I think the government stability maybe took a bit of a bump upwards recently. You know, Canada, and particularly Vancouver, with its amenity and government stability, is going to be attractive to people for a very long time from all over the world. And so I think this high G in that denominator of R minus G, I think that's real and here for a long time.
Thank you. Another question here. Do we still have money launder issues with real estate purchases? Is the government doing anything about it?
So the answers are, we don't know, and yes. So the government is, you know, right now the Cullen Commission is meeting. I think that's money laundering, maybe with respect to gambling. But, you know, government is trying to do something about money laundering in real estate. Things are getting more transparent. You have to identify who you are as the owner of a property. You can't hide behind numbered companies as easily anymore. So I think government is trying to do something about it. We don't know how big the issue is. You know, my colleague Soar Somerville was on a panel where they said, well, if we're like the Netherlands in the 1990s, where they did a very clear comparison, then money laundering is a, you know, many $billion a year problem. But we don't know, you know, because unfortunately, you know, people don't say, identify themselves as, yes, I'm a money launderer when they buy properties. And, you know, you look for things in deeds or titles or mortgages that say, ooh, maybe that's a red flag that looks like money laundering. But, you know, often those things that seem like they could be money laundering are perfectly innocent. So it might be huge, it might be tiny. I don't know. And I don't think anybody does.
Okay, another question here. Why isn't co-op housing looked at more seriously as an affordable way of living, especially in Metro Vancouver?
Well, I think, you know, even strata where you know, basically control your own unit and share decisions about the larger whole are a nuisance. Collective decision making, you know, I mean, many academics here, of course, have been on academic committees and they know how easy that is to make a decision. When it's real estate, people get very nasty with each other. So, you know, I think if you have people who work together collegially, it might work okay. What I will say, though, is I think it is likely that we'll see alternative to ownership arrangements. Maybe it's just landlord-tenant, but some kind of hybrid ownership might be the way we have to go if this R minus G issue, that properties are just going to be really expensive relative to a lifetime of earnings. We'll have to figure something out so people can save up and get some control over their homes.
Okay. Yeah. So there's no new questions have come in. So thank you.
Thank you.
Thank you to everyone who came this afternoon. We know it's sunny. We appreciate you took time to sit down with your laptop or iPad and join us for this lecture. I look forward to seeing hopefully some of you over the next 2 lectures. As mentioned, we still have quite a bit more space for the April 29th lecture. And thank you very much for Dr. Thomas Davidoff for coming here and taking time to spend with us this afternoon. I really appreciate your insight into something I thought many people, I'm sure, have questions about. What does COVID mean when it comes to commuting and living and housing prices? So thank you very much. Thank you very much,
so much.
everyone, and take care and stay safe.